Hello, and welcome to this month's monthly market update from Kingdom Focus Financial. We're glad you're here. Hope to give you some valuable information. I'm here along with Chuck Etzweiler this month, and we are planning to dive into the middle of our theme, right? Our theme this year, Chuck, is wiser.
Yes,
and
it is.
Today we're going to talk a little bit about the S and what it stands for and how it plays in to our portfolios and what we're watching this year. So Chuck, go ahead, jump in. What do you got for us this month?
Yeah, first of all, great to be with you, Michael. And I love this topic. Boy, we've been doing research on this for 15 to 20 years. So we decided to include it in our acronym this year. And we'll go back to the Latin root word of S, which is secular. And I think that a lot of people, at least kind of in the church, will use the word secular to mean those outside of the church. However, it does have a second derivation in its meaning. It's actually derived from the Latin word seculum, and it means of the age or a generation. So there's two different types of markets that measure time. There's the cyclical bull or bear market, which is shorter term, let's say 3 years or less. But there's the secular bull or bear market, and that's what we're going to get into today, which is, I'm going to take the liberty, Michael, to maybe define a generation as 18 years. I know there's other measures, but it's the age of majority in the United States. It's when we think that children become adults. So secular, measuring the length of time from a longer perspective, and we're going to kind of use that 18-year period. Now, what's interesting is we got a lot of charts to show today. If we actually look at the first of our line graphs, we put this one together. You go back 100 years, and you actually see patterns that begin to take shape. There's two types of markets from a secular standpoint. There's the secular, we'll call it either sideways, flat, range bound, or bear market. It's represented by a red horizontal line, which basically, if you can picture in your mind a bridge, Michael, and maybe a bridge from one that's chasm to the next, you're going over, let's say, a canyon. And the bridge underneath it, picture V's and W's strung below it, but it never penetrates above the bridge. That's a secular bear market. And we've had three of those in the last 100 years. We had one from the crash of 29 out through World War II to 1948. What was interesting is that secular bear market, it peaked in September of 1929, and it never crossed over until the fall of 1948, where it was 19 years previous. Little did we know that we're going to have this manufacturing boom that was post-World War II that leveraged the technology that was used in the war, and it lasted 18 years until 1966. We've all read about it in the history books. Maybe some of our investors lived through parts of that. So here's the time frame, Michael. It's February of 1966. I want you to think about this. The Dow Jones Industrial Average closes above 1,000 for the first time. We closed above 50,000 earlier this year, but 1,000. It doesn't cross over and hold it again, Michael, until August of 1982, a 16-year, again, range-bound or secular bear market. In 1983, we get this new invention called the personal computer, which is then followed up by the World Wide Web, as we used to call it, the internet in the early 90s, followed up by cellular mobile smartphone technology with an 18-year secular bull market from 1982 until March of 2000. Most of us have not all lived through the tech blow-off bubble. Think about this, Michael. In March, I should say, of the year 2000, following the 1999 market blow-off top, March of 2000, the S&P was at 1,550. Now we're at 7,100 today. But it didn't cross over the S&P again and hold until April of 2013. So we would suggest that this secular bull market began in April of 2013. Historically, they last 17 to 20 years on average. That would take us out until the earlier mid part of the decade of the 2030s. And I would just propose to individuals, as we'll get into, that that's extremely important in allowing history to tell you maybe where you are today. We have another chart. It would be the second of these particular line graphs. Morningstar put this together. What I love what they did is they attached some of the historical periods of time. They went back, Michael, to 1870. Now, we all know from the history books that the Civil War ended in 1865. And I want you to think about this. Put yourself back in that period. Certainly, here we are in the great state of Pennsylvania. Many of us know what happened at the Battle of Gettysburg. We visited that historic site. Picture yourself back in 1865. You're looking out the window of your house and you see the remnant of gunfire that the war had just ended, but there's still residue of the smoke, et cetera, cannonball fodder. And you say to yourself, oh my goodness, I'm going to invest in the stock market. The next 33 years from 1870 to 1902 are going to be this bullish industrial revolution led by certainly the Transcontinental Railroad. This is what happens in periods of despair. And what people don't understand is when you have these periods prior to the Civil War where we had a long-term bear market, is that people get, I use the word almost depressed, in that, why would I ever want to invest in stocks? Think about in the early 1980s when interest rates were 15.5%, you were getting 16% on a CD. On the cover of Time magazine was an article, Equities Are Dead. Why would you invest in the stock market in the early 80s when you can earn 15.5% in a CD, was the thought. Well, the thought was also interest rates are going to remain high forever. Well, they didn't. And the stock market took off from 1982 to 2000 in a bull market. Just the opposite happens, Michael. When you look at the year 1999 or 2000, people start plugging into their calculator, the retirement calculator, hey, I'm going to get 15 to 20% every year in stocks because stocks always go up. So you almost have this dynamic, and that's what that third bar chart shows, that a secular bull market always begins when the price earnings ratio is very low, and they end when it's high. So what's a low price earnings ratio? Historically, single digits or maybe low teens, where a high one is in between the mid 20s and let's say the low 30s. Now, we got up to 23 times forward PE back in October. That has since come in fairly significantly. We had a dual dynamic, Michael, that's very rare, where you had stock prices come down during this Iran conflict, let's call it sell-off, but you also had the earnings growth move up. So what it means, the PEs came down to about 19. So we were saying last year, it's premature to talk about a blow off top, a bubble that's bursting. The interesting thing behind all this, Michael, is there will be a bubble at some point. There always is, like 1929, 1966, 2000. We just don't believe it's today. And we were talking about in the green room prior to this that it's most likely not in the near term here, that when you look at history, it would tell you, to kind of use a baseball metaphor, that maybe we're in the fifth inning, maybe we're in the middle to this. So
Yeah.
it is important to look at that. Like, yep, go right ahead,
Oh,
please.
yeah, absolutely. And you look at these charts, they're helpful. And to put it in perspective, I think clients of our office, they've heard us refer to sort of a staircase, right? The market
Yes.
looks like a staircase and how it goes up. You have that. Think about energy usage, not talking energy investment, but of our physical body. We have to lift up and then we get on the top of that step and we pause, right? And then we lift up and we sit on the top of the next step and we pause. And that's what these charts are
Yeah.
showing. And while you're in the middle of that climb, so much is happening. But every once in a while, you have to stop and pause before you begin that next leg up in doing that. Now, Chuck, I think one of the key things is, I mean, today we're kind of taking that telescopic view, like we're really zooming way out to try to
Yeah,
help people understand the longer term picture, because our culture today wants us to focus in on what happened yesterday, right?
exactly.
And and it doesn't mean, okay, well, I should get out and wait 20 years and then get back in, because that's, as we're managing portfolios, I mean, the market's still moving. And I think that those, the charts you shared are great in depicting that even within there, when stocks are flat, often interest rates tend to be a little bit more buoyant. And so our portfolios rotate and shift depending on what's happening. And it's not a everything down, it rotates sectors during those secular bear markets that are there. And so there are opportunities that exist in both the secular bull and the secular bear markets. Um, and it comes back to something
They're
we've
just different.
talked about for years. You
Yeah,
know, you have to not get lost in the forest, right? You have to be able to
exactly.
see the long term point of where we're headed. And every year we go down 5 to 7% once or twice, right? It's sometimes in one day, and you never knew it happened if you weren't paying attention. Sometimes it lasts a month, like March. I mean, we had a rough March this year,
And we
um,
did.
and then April has brought it all back, right? And so we go through those, and if you just measure start to year, end of year, it looked okay. But for those that are measuring day to day, there was a point of uncomfortableness. Well, this is just taking that to the nth degree, right? We go through, and this is suggesting, every, I'm going to say 15 to 20 years. I like your generational 18-year time frame, but statistics play every 15 to 20 years. We're going to go through a period where
Right.
this market compounds pretty well. It's not a scary thing, it's a normal thing. And those moments of pause are where we start to reformulate, and there are opportunities as we walk through them, but we're positioning. We're positioning for what is the next thing forward. Right now, this leg is being driven by AI and technology. Uh,
Absolutely.
and I mean, I know you got more to say. I don't want to steal it from you, but I mean, I
Yeah.
feel we've got a ways to go as this continue to play out. But yeah, no, good stuff.
Yeah. Yeah. I love your analogy, I'll call it, of the stair step. That paints a perfect picture. And I think maybe I could wrap it up with this: the question we got last year, and justifiably so, and we had to make a defense for why are we not in a bubble? And there's a lot of hedge fund managers, a lot of economists, pretty prominent ones too, that were making that call, and we were somewhat adamant. And I think there's three reasons, Michael. You just mentioned the time frame, the 15 to 20 years. In April now, we're 13 years into what is normally 15 to 20 years, and post Civil War was 32 years, which are secular bull markets. So the length doesn't meet the historic average. The other is this second to last chart, Michael, which was put out by Merrill, and I thought they did a good job. They talked about cumulative price returns. So even off of the 2009 March low, where, by the way, we hit 666.76, that's 666, where we're now at 7,100. We've had a price return of 912%. That's cumulative. That's a lot. But the bull market of the 80s and 90s was 2,353. The bull market post World War II was nearly 1,200. So we don't meet it from a cumulative price return. But Michael, I'll end on this one here, and then I'll pass it back to you. I think the last chart is key. I understand when people say, hey, look, over the last 1 year, trailing 1 year, markets are up 20%. Over the last trailing 2 years, they're up more than 20%. The last 5 years, close to 15 annualized. 10 years, close to 15 annualized. But if you look at the 20-year number, Michael, at 11%, the historic average is 10.9. We're right there. History would suggest this: when the bubble does happen, that 20-year number gets elevated in the period you're in versus the historic average. We're right at the average. So this would say to me that we continue down a pathway of a secular bull market. There will be pullbacks, as you just said, they will be normalized. But what it says is that the opportunities still are great to be invested in. You just said whatever is driving this historic run. And for now, we're going to call it the artificial intelligence, automation, robotics bull market of the 2020s and hopefully into the 2030s.
Yeah, no, it makes a lot of sense. And um, again, we've thrown a caution flag up throughout this year as one where we're expecting volatility. This isn't contradicting that. We're not changing our viewpoint. I think we will continue to see volatility, but when we step back off of the track, right, we're seeing that it's still going to go round and round. And
So
uh, I anticipate that the summer might have some surprises in store. We've talked before, we're in a midterm election year. And so the short term focus shows us there's bumps on the road. But when we step back
absolutely.
out, it sees we're still on track for where we want to be. And I think again, I can't predict the future, no one can, but if we're following historical trends and guidelines, we've got a couple more years where this is probably going to run. It'll be interesting. I'll just give a little tidbit as we look ahead. It'll be really interesting to watch the next presidential cycle. And I'm going to say the
Certainly.
midterm after the next president would be, for me, maybe a really key trigger to just kind of put a
Yeah.
target out there in the future. And that's 6 years out, maybe 4 years out,
4 years out.
and 4 years
Exactly.
out and doing that. And so I think we got to navigate carefully and cautiously, but I would say I got a smile on my face as we look ahead um, to what the next couple of years hold moving forward. So,
Well said.
hey, Chuck, as always, thank you for providing some insights. Thank you for being here, taking time. It's always good chatting with you. Although we talk every
Thank
week,
you.
I think our clients need
Absolutely.
to hear that. They need to know
Yes.
we're putting our heads together every week and looking at our portfolios, and then we take a few minutes each month and try to boil that down into you. So if you like what you heard today, if this has been helpful, go ahead and hit that subscribe button so that you follow our uh, monthly updates and other information we have on our website and on our YouTube channel related to financial topics. It's the way you get notifications. And feel free to share. Share it with others. I know there's a lot of angst out there in the market with what's going on. And maybe this just gives a little bit of insight. Because when we step back and focus on the long-term picture, we should see a lot of positive things looking ahead in doing that. Once again, thanks for being here. We appreciate you, those of you who trust us as your clients. And we've been getting a lot of referrals lately. And so a big shout out to you as well for sending other people our way. Keep doing that. We love meeting new people. We love helping them navigate through their financial journey. And hopefully this is one piece that helped you navigate yours today. We'll see you next time. Have a good day.